Imagine this. The single largest asset manager in the world quietly moves to $0.1 trillion. Yes, trillion with a T out of America. No press conference, no viral headlines, just a financial earthquake that could ripple into your bank account, your investments, and even the future of the US economy. Most people assume that massive financial moves like this are harmless, or that they only affect Wall Street elites. But what if I told you that this could impact your 401k, your savings, and even the prices you pay at the grocery store? Today, we're going to uncover exactly why BlackRock made this unprecedented move, what it reveals about the hidden forces shaping global finance, and what you need to know to protect your money. But first, we need to go back, way back. To understand BlackRock's $2.1 trillion exit, we need to understand the world it operates in. BlackRock isn't just another investment company. Founded in 1988 by Larry Fink and a small group of financial strategists, BlackRock started as a risk management firm. Its mission was deceptively simple: help institutions manage risk and maximize returns. Over the decades, BlackRock grew at a pace that was almost unimaginable. By the early 2000s, it was managing hundreds of billions. Then, after the 2008 financial crisis, BlackRock became the go-to firm for governments and banks needing guidance on trillions in troubled assets. Essentially, it became the quiet puppeteer behind global financial stability. Here's the twist. While BlackRock was seen as a stabilizer, it also accumulated enormous influence over global markets. Today, it manages over $10 trillion in assets, more than the GDP of the United States. Think about that for a moment. One company holds the financial equivalent of the entire US economy. And now, for the first time in decades, it's moving a staggering portion of that money out of US markets. But why? To understand the $2.1 trillion withdrawal, we have to look at causes and triggers over the past 20 years. Several factors converged. 1. Rising interest rates. The Federal Reserve's aggressive interest rate hikes made US bonds less attractive. For a firm managing trillions, even small interest rate shifts can trigger moves worth billions. 2. Global economic shifts. Emerging markets like China and India are growing faster than the US market. BlackRock isn't just chasing profits, it's chasing where the future of capital growth is. 3. Regulatory pressures. New government regulations on large asset managers are increasing transparency demands, limiting certain high-risk strategies, and making some US investments less flexible. Now, here's the subtle but crucial point. $2.1 trillion, ISNT, just a number at S. A signal. When BlackRock moves money on this scale, it's like the Fed issuing a silent warning about the health of the financial system. But to fully grasp why this move is so dramatic, we need to see the rise and influence of BlackRock over the last 3 decades. BlackRock's rise was built on a few key innovations. Risk modeling, using advanced analytics and predictive software. BlackRock could forecast market movements better than almost any competitor. Institutional trust. Governments, pension funds, and large corporations relied on BlackRock's guidance after the 2008 crash, cementing its position as the trusted giant. Index funds and ETFs. With the creation of iShares ETFs, BlackRock gave everyday investors access to institutional-grade portfolios. This democratization made it the largest player in retail finance too. By the late 2010s, BlackRock wasn't just a company, it was a global financial ecosystem. Its influence spans banks, governments, real estate, commodities, and even tech companies. Decisions made in its New York offices can ripple across Tokyo, London, and Mumbai within hours. Yet, with great power comes great responsibility and fragility. So, what broke the system? Why now? In 2025, several warning signs appeared. 1. Inflation and stagflation fears. Persistent inflation has devalued certain US assets, especially long-term bonds and treasury notes. For a firm managing trillions, these small shifts matter exponentially. 2. Geopolitical risk. US trade tensions, sanctions, and global conflicts made certain markets riskier. BlackRock is known for being cautious, and now it's moving to protect capital before the storm worsens. 3. Internal strategy shift. Sources indicate that BlackRock has been gradually reallocating capital toward emerging markets, commodities, and sustainable energy funds, areas projected to outperform the US in the next decade. The breaking point wasn't a single event. It was a perfect storm of economic, geopolitical, and strategic factors. The result: a decision to move to $0.1 trillion out of US holdings, the largest shift in history. The move created instant ripples in financial markets. Bond markets. Yields spiked as massive sell-offs pressured prices. Stock markets. Certain sectors, particularly US tech and financials, saw temporary dips. Investor panic. While institutional investors understood the reasoning, retail investors were blindsided. Social media lit up with speculation, misinformation, and fear-driven headlines. Here's the paradox. For most Americans, the $2.1 trillion move doesn't immediately change day-to-day life. But in weeks and months, the effects become visible. Interest rates, mortgage costs, and even retirement fund growth rates can all feel the ripple. Historically, the US government and Federal Reserve have attempted to stabilize markets when mega firms move capital, bailouts, and stimulus. After 2008, trillions were injected to prevent market collapse. Quantitative easing, key. Central banks purchase assets to stabilize prices. Regulatory tweaks. Stricter oversight to prevent systemic risk. But these methods are increasingly limited. The financial ecosystem today is more complex, more interconnected, and faster moving than ever. Traditional fixes that worked decades ago may not be sufficient to contain. $2.1 trillion Australian dollars shift by the world's largest asset manager. If you think a $2.1 trillion move is unprecedented, think again. History has a pattern. Look back at past financial shocks. 2008 financial crisis. Lehman Brothers collapse triggered a worldwide panic, wiping out trillions in household wealth. Dot-com bubble 2000. Speculative tech investments burst, causing major losses for everyday investors. 1970s oil crisis. A sudden shift in global commodities caused stagflation that lasted years. What connects all these events is the speed of capital movement and the concentration of financial power. In each case, ordinary people, retirees, small investors, and wage earners felt the consequences far more acutely than the ultra-wealthy institutions. Today, BlackRock's $2.1 trillion move is following a similar pattern, but on a scale larger than anything we've seen before. This isn't just Wall Street, this is Main Street too. Let's break it down in real terms. What does this actually mean for someone like you? 1. Retirement accounts. 401k. ERA's BlackRock manages trillions in ETFs and index funds that feed directly into retirement portfolios. A sudden withdrawal can temporarily depress stock values, lowering returns even for long-term investors. 2. Interest rates and loans. As bonds and treasuries adjust to the withdrawal, yields rise. That might sound good, but rising yields can also mean higher mortgage rates, car loans, and credit card interest. 3. Stock market volatility. Certain sectors, especially tech and financials, could experience sharper dips. For those invested in these sectors, short-term losses are almost inevitable. 4. Inflation pressures. By shifting funds internationally, capital leaves US markets. Reduced liquidity can push domestic prices up, subtly impacting everyday goods. In short, BlackRock's decisions, while technically institutional, ripple directly into your wallet. Let's map the cause and effect chain. 1. Rising rates and global opportunities gives BlackRock reallocates trillions. 2. Mass withdrawal gives US bonds and equities adjust to new demand levels. 3. Market ripple gives interest rates fluctuate, stock volatility increases. 4. Everyday impact gives higher loan costs, reduced investment growth, potential inflation effects. This isn't hypothetical. Historical precedent shows that even small capital shifts by megafirms can lead to month-long economic effects. Multiply that by $2.1 trillion, and the stakes are enormous. Here's some data to put this into perspective. BlackRock's $10 trillion in assets is larger than the GDP of almost every major country. Except the US, $2.1 trillion is roughly twice the US defense budget for an entire year. Historical crises show that wholesale capital movements can erode 10 to 15% of market value in months, even without a recession. The repeating pattern is clear. When a single institution with immense financial power reallocates capital, markets react, and the effects trickle down. Yet most people remain unaware because the media often frames these moves as abstract or technical, rather than showing the real-life consequences. We can learn 3 critical lessons from past patterns. 1. Diversification is key. When major firms shift capital, certain sectors are more affected than others. Diversified portfolios reduce risk. 2. Timing matters, but so does strategy. Trying to time the market based on BlackRock's moves is risky. Long-term, informed strategy wins. 3. Transparency is rare. The average investor rarely sees moves of this magnitude in real time. Being aware of market signals and not panicking is essential. So, what should viewers take away from all of this? 1. Your money is not isolated. Even if you're a small investor, decisions by BlackRock and other mega firms can affect your investments and loans. 2. Understand risk beyond the US. Emerging markets and global capital flows are increasingly interconnected. The US dollar and domestic markets are no longer isolated safe havens. 3. Be proactive, not reactive. This isn't a reason to panic. It's a reason to review your portfolio, understand allocations, and prepare for potential market fluctuations. Here's the real takeaway. BlackRock isn't just moving money for fun. These $2.1 trillion shifts signal confidence in some markets and concern about others. While it doesn't mean a collapse is imminent, it does mean that the financial system is more fragile than most people realize. Ask yourself, if a single company can move trillions with global impact, how stable is the system when multiple firms act in concert? And more importantly, what does that mean for your financial future? If you found this breakdown eye-opening, hit like and subscribe. We're going to continue tracking how mega firms like BlackRock move the markets and what it means for everyday investors. Comment below, how are you preparing for these massive financial shifts? Are you diversified, or relying on traditional strategies that might not hold up? I want to hear your strategy and we'll cover the most practical tips in upcoming videos.